All right, strap in, everyone. We're going deep on private credit.
Ooh, private credit.
Yeah, and it's a market that's kind of blown up to $3 trillion.
3 trillion. Wow.
3 trillion, it's crazy. Yeah, you might not have heard much about it, but trust me, it's a big
I
deal.
bet.
Big money is pouring in, and investors are seeing like double-digit returns. But, is it all it's cracked up to be? We've got a whole bunch of sources here painting a pretty interesting picture. A mix of opportunity and some serious risk.
I see.
We're talking major institutions, pension funds, heck, even everyday investors. Like, you can get a slice of the pie now.
Sounds juicy.
Oh, it is. So to help us make sense of it all, I've got an expert here
Hey, everyone.
who can walk us through those potential pitfalls and hopefully those big opportunities.
Absolutely. Happy to be here.
So first things first, let's break it down. What exactly is private credit, and why is everyone suddenly so interested?
Well, at its core, private credit is basically just lending, but it happens outside the traditional banking system. So instead of going to a bank for a loan, businesses are turning to these private lenders,
Private lenders, like who?
like investment firms, hedge funds, sometimes even just, wealthy individuals.
Okay, so they're cutting out the middleman, the banks.
Right.
But why are companies choosing this route, and what's driving all these investors to private credit? Our sources keep mentioning yields of like 12% or more. That's got to be tempting.
Yeah, those yields are definitely eye-catching, especially these days where, bonds are offering pretty measly returns and the stock market's been a bit of a roller coaster.
Yeah, I feel that.
Investors are hungry for yield. And private credit, it's like a feast right now.
Right. Like in 2024, those average returns were something like 14%.
More than double what the S&P 500 did.
That's wild. No wonder everyone's jumping on board. But hold on, let's not forget about those warning signs our sources have pointed out. There's got to be a reason for these sky-high yields, right? What's the catch?
Well, the saying higher returns usually mean higher risks.
Of course.
And with private credit, you're often dealing with less regulation and definitely less transparency compared to traditional lending.
I see.
Private lenders, they've got more freedom. They can structure loans differently, take on riskier borrowers.
So that means potentially bigger returns, but also a bigger chance of things going wrong.
Exactly.
So there's more potential for reward, but also more potential for a disaster.
Yeah, that's one way to put it. And that's why it's so important to really get this market before, diving in head first.
Absolutely. Now, speaking of diving in, one of our sources mentioned a really interesting catalyst for this whole private credit boom. And it's a bit of a curveball, Trump's China tariffs.
Oh, yeah, those tariffs.
It's not something you'd immediately think of as like a financial game changer.
Well, those tariffs really squeeze some companies, force them to find ways to manage those extra costs.
And that's where private credit came in.
For some, yeah, they turn to private loans to refinance their debt, basically buying themselves time and maybe even dodging bankruptcy.
So private credit was a lifeline for those struggling to adapt. That's a pretty crazy ripple effect from those trade wars. But with all this money flowing around, who's actually benefiting the most from this whole private credit surge?
Right now, it's mostly manufacturing and energy. Companies that need a lot of capital, to upgrade equipment, expand, deal with those supply chain issues we keep hearing about.
Right.
They're turning to private lenders to fuel their growth, especially since banks got a lot more cautious after that whole banking crisis in 2023.
Yeah, that was a mess.
In fact, private funds now handle a whopping 40% of U.S. mid-market deals.
40%? That's a huge chunk. But hold on, didn't one of our sources mention something about potential defaults? Are we staring down a wave of bankruptcies if things take a turn for the worse?
It's definitely a possibility. MSCI, they're a big financial data company, and they're predicting that maybe even 15% of these private loans could default if interest rates stay high.
15%. Oof, that's a lot of potential losses. A good reminder that those high returns aren't a guarantee.
Definitely not. Diversification and due diligence, those are your best friends in this market.
Now, talking about investors, there's BlackRock. They're like the giant of asset management. And one of our sources highlighted their massive investment in, of all things, green mobility loans.
Green mobility loans, huh?
Which seems a little strange, right? Given how much the EV market has been struggling lately.
It is interesting. While some investors are pulling back from EVs, BlackRock seems to be doubling down. Like they're saying, yeah, the sector's got problems now, but we believe in the future of electric vehicles.
A high conviction play, huh? Are they just being contrarian? Or is there a method to their madness?
Probably a bit of both. BlackRock, they're known for making those big strategic long-term bets. This could be one of them.
Maybe they're seeing opportunities that others are missing, or maybe they're just willing to ride out the storm.
Yeah, it's hard to say, for sure.
It's like there's this tug of war happening. On one side, we've got these warnings about defaults, and on the other, these bold bets on new industries. Makes you wonder who's going to be right in the end.
That's the billion-dollar question, isn't it? And that's exactly why it's so important to understand what's really going on in this market. It's not just about chasing returns, it's about carefully weighing the risks and the potential rewards.
Absolutely. Okay, so we've got banks pulling back, investors clamoring for those juicy yields, companies using private credit to, navigate this changing world. It feels like a real financial shakeup is underway. But what about the everyday investor, the person listening to this right now? How can they get in on this private credit action?
Well, one of the easiest ways is through private credit ETFs.
ETFs, those are getting popular.
They are. They pool money from a bunch of investors to build a diverse portfolio of private loans. Makes it a lot easier for individuals to participate.
That sounds pretty straightforward. And we've even got platforms like Percent offering access to those asset-backed loans with potential yields as high as 18%. It's like private credit's gone mainstream.
It has to a certain extent. But remember, easier access doesn't mean it's risk-free. These ETFs come with their own challenges.
Oh, I bet. So what are the red flags investors should watch out for?
First, lockup periods. A lot of these ETFs have them, meaning your money could be tied up for 5 years or even longer.
Wow, 5 years. That's a long time to have your money locked away. What if something comes up?
Exactly. It's a serious consideration. Then there's the lack of transparency. Unlike the stock market, where companies are always reporting their earnings, private loans, well, they don't really offer that level of detail.
So you're kind of in the dark.
A bit, yeah. You're relying on the fund manager's judgment and, whatever limited data they provide.
Less transparency, longer lockup periods. That's two strikes. What's the third red flag?
Fed rate cuts. If interest rates drop, the yields on those floating rate loans could tank, and that'll eat into your returns. It's a bit of a double-edged sword. Rising rates make those high yields attractive, but falling rates can quickly wipe out your gains.
So it's a delicate balancing act. Should everyday investors just steer clear of these ETFs then?
Not necessarily, but you got to be cautious. Even Moody's, the big credit rating agency, they've warned about the risks, especially for retail investors who might not fully grasp all the complexities.
So it's like stepping into a casino. You might hit the jackpot, but you also got to be prepared to lose it all.
That's a good analogy. And just like with any investment, knowledge is power. Before jumping into private credit ETFs, do your research. Understand the risks involved and make sure they align with your overall investment goals and your risk tolerance.
Sound advice. All right, so we've covered the basics, the allure, and the risks. But what about the future? Where is all this headed?
Ah, the million-dollar question.
Right. Our sources had some pretty interesting predictions for 2025. Morgan Stanley, for instance, they're predicting $1 trillion in new private credit loans this year alone.
Wow.
That's a staggering number. They're basically saying this market's going to keep booming.
Yeah, they're definitely bullish. But then you've got BlackRock, one of the biggest asset managers in the world, and they're taking a more cautious approach. They're actually shorting U.S. debt and warning about potential spikes in defaults if the Fed cuts rates too quickly.
So it's a mixed bag, bullish projections from one giant, cautionary warnings from another. What should our listeners who might be thinking about dipping their toes into private credit focus on amidst all this uncertainty?
Well, if you take a step back and look at the bigger picture, it's pretty clear we're in a period of major economic uncertainty, right? Inflation's up, interest rates are volatile, there's geopolitical tension. It's hard to predict what's going to happen next.
So how can investors navigate this minefield? Where do we even begin to make sense of it all?
My advice, focus on what I call pick and shovel plays.
Okay, I love the imagery, but break it down for us. What are pick and shovel plays, and how do they apply to private credit?
Think back to the California gold rush. Instead of trying to strike it rich by digging for gold themselves, some people made their fortunes by selling the picks and shovels. They profited from the boom without taking on the risk of actually mining.
Ah, I see. So in private credit, pick and shovel plays are investments that ride the wave of growth, but without betting on specific companies or sectors that might fail.
Exactly. It's about finding those investments that capitalize on broader trends and have a bit of built-in downside protection.
Okay, I'm intrigued. Give me some concrete examples. What are some pick and shovel plays in private credit?
One example is data center loans. Think about it. AI is exploding, and that means huge demand for computing power.
Makes sense.
And data centers, well, they're the backbone of that whole infrastructure.
Right?
They need money to expand, and private lenders are stepping in to finance those projects. It's a way to tap into AI's growth without betting on a specific AI company that might flock.
So you're betting on the infrastructure that's powering the gold rush, not the individual prospectors.
Exactly. Another interesting area is asset-backed finance, or ABS ETFs.
What's the advantage there?
Well, those ETFs invest in loans that are backed by collateral, like tangible stuff, factories, equipment, even trucks. So if a borrower defaults, the lender can seize those assets to recoup some of their losses.
So it's like having a safety net built in.
Exactly. And that can be really appealing in a market like this, where uncertainty is the only sure thing.
This has been really insightful. We've covered so much ground, but as they say, this is just the tip of the iceberg.
There's always more to learn. Welcome back to our private credit deep dive.
We've covered a lot of ground from the basics to all that booming growth and those crazy returns, but, high rewards often come with, well, higher risks. And to really understand those risks, we got to look beyond the hype, see the bigger picture.
Exactly. And one of the best ways to do that is to look back, see what history can teach us.
Right, learn from the past.
Yeah, the history of lending, especially outside the traditional banking system, well, it's full of these booms and busts. It's a pattern, it keeps repeating.
Okay, so let's rewind. What are some of those big private credit blowups that we can learn from today?
One of the most spectacular, and maybe one of the biggest warning signs, is the collapse of long-term capital management, LTCM, back in 1998.
LTCM, I vaguely remember that. Wasn't that a massive hedge fund?
Huge.
And didn't they have, like, the best financial minds running the show?
Oh, yeah, they had it all. Nobel Prize winners, Wall Street veterans, like the dream team of finance.
Wow.
Their strategy was basically to use these super complex mathematical models to make these huge bets in the bond market, private credit included.
So they were like the brainiacs of Wall Street, using algorithms and leverage to outsmart the market?
Yeah, you could say that. And for a while, it really seemed like they couldn't lose. But their brilliance, maybe their arrogance, led to their downfall.
How so?
They underestimated the risks, big time. And when Russia defaulted on its debt in '98, it triggered this chain reaction, sent shockwaves through the whole global financial system. LTCM, even with their all-star team, they couldn't escape it. They needed a massive bailout to survive.
A bailout. Nobel Prize winners needing a bailout. That's pretty humbling. A reminder that even the smartest people can get it wrong.
Especially in a market like private credit, with all its complexity. The LTCM story, it shows us the dangers of overconfidence, too much leverage, and getting too complex.
Humor's meeting reality, right?
Exactly.
Okay, so that's a lesson from the 90s. But haven't we seen similar things happen more recently? Didn't private credit have a role in the 2008 financial crisis?
It did. Subprime mortgages, those were at the heart of it, of course. But private credit, it definitely made things worse. A lot of those risky mortgages, they were bundled into these complicated securities and sold off to investors, private credit funds included.
I see.
And they were attracted to those high yields, without really understanding the risks underneath.
So they were buying a ticking time bomb?
Pretty much. And when the housing bubble finally burst, all those securities, they went toxic. Led to a wave of losses that brought the whole financial system to its knees.
It sounds like a recurring theme. Lack of transparency, hidden risks, everyone chasing those high yields, and then boom, everything blows up. Are we seeing any of those same red flags today in private credit?
There are definitely some similarities. The market's grown so fast, a lot of new investors are jumping in, and they might not realize the risks. There's always the chance of overconfidence and too much leverage leading to trouble.
So history gives us some warning, but what about now? What's in place to prevent another private credit meltdown? What about the regulatory landscape? What are the rules for private credit these days?
Compared to banks, private credit's pretty lightly regulated.
Why is that?
Well, historically, private credit has been seen as this niche market for, sophisticated investors, institutions, high net worth people, the kind of people who are supposed to know how to assess the risks themselves. Regulators haven't focused on it as much because it wasn't seen as a threat to the whole financial system.
But like we said before, private credit's going mainstream now, with everyday investors getting access through those ETFs and online platforms. That's got to be worrying regulators, right?
It is. As more retail investors get involved, regulators are getting concerned about systemic risks, and protecting those investors.
Yeah, makes sense.
They're starting to ask, what happens if there's a huge default in the private credit market? Could it spread to the rest of the economy?
So are they doing anything to address that? What's coming down the pike in terms of regulation?
There's a growing push for more oversight, both in the U.S. and globally.
What kind of changes are we talking about?
Well, some ideas being floated around include stricter capital requirements for private credit funds, making their lending practices more transparent, and maybe even limiting who can invest. There's even talk of giving regulators more power to monitor and intervene in the market.
So more rules, more scrutiny, and maybe less access for everyday investors.
Yeah, that's one possible outcome. The goal is to find that sweet spot, between encouraging innovation and protecting the whole system from too much risk.
It's a tightrope walk.
It is.
Sounds like the regulatory landscape is changing fast. Investors need to pay attention because it could really shake up the market in the years to come.
Absolutely. The rules of the game are changing, and staying informed is key.
Okay, so we've covered the history, the potential risks, and those changing regulations. It's a lot to think about. But let's not forget, private credit is generating some pretty amazing returns for some people.
Very true. And in part 3, we're going to shift gears and explore some of the most promising sectors and strategies in private credit, from direct lending to distressed debt. We'll talk about how to build a diverse private credit portfolio, one that balances risk and reward.
Sounds good. Looking forward to diving into those opportunities. See you in part 3. Welcome back for the final part of our private credit deep dive.
We've talked about the history, the risks, the rules, but now let's get to the good stuff.
Yeah, the opportunities. Let's talk about where the action is.
All right, so one area that's really hot right now is direct lending.
Direct lending, right? We touched on that before, but just to refresh everyone's memory, what is it exactly and why is everyone so excited about it?
It's actually pretty simple companies. Instead of going to a bank, they borrow directly from private lenders, usually through funds managed by specialized firms.
So it's like a business-to-business loan cutting out the bank.
Exactly. And that can be good for both sides.
I can see how it would appeal to borrowers, less red tape, maybe they can get the money faster. What's the upside for the lenders?
Well, for lenders, direct lending can mean higher returns. Remember, private lenders are willing to take on more risk than banks, and they're often okay with structuring loans that banks wouldn't touch.
Makes sense.
And that means higher yields for investors who are comfortable with a bit more risk.
Right, risk and reward. So what kind of companies are using direct lending?
We're seeing a lot of activity in the middle market, those companies that are too big for a typical bank loan but too small to go to the public bond market.
Got that.
Often, they're growing businesses, good fundamentals, but they might not fit the strict requirements that banks have.
So it's filling a gap, giving these companies access to funding they might not otherwise get.
Exactly. It could be a win-win. Companies get the money they need, and investors have a shot at those higher returns.
But of course, no investment is without risk, right?
Right. Absolutely. Thorough due diligence is crucial here, really understanding the borrower's business.
Okay, so direct lending is one hot area. What else is on your radar?
Another interesting area, one that's not for the faint of heart, is distressed debt.
Distressed debt? That sounds kind of scary. Why would anyone want to invest in companies that are already having problems?
Well, it's not for everyone, that's for sure, but for investors who aren't afraid of risk and have a knack for finding those diamonds in the rough, distressed debt can be very profitable.
Diamonds in the rough, huh? Okay, I'm listening. Walk me through this. How does it work?
Basically, you buy up the debt of companies that are in trouble. Maybe their sales are down, they have a lot of debt, maybe they're even facing bankruptcy.
I see.
The idea is to buy that debt cheap, hoping the company can turn things around, or maybe you can get some of your money back through a restructuring or a liquidation.
So you're like a financial first responder coming in to try and salvage something.
In a way, yeah, it's a high-stakes game for sure. Requires a deep understanding of how restructuring works, the legal side of things, and, you got to be comfortable with uncertainty.
Not for the casual investor, then.
Definitely not. But the rewards can be huge if you play it right.
Okay, so direct lending for growth opportunities, distressed debt for those with a higher appetite for risk. But when it comes to actually building a private credit portfolio, what are some good strategies?
The most important thing, no matter what you're investing in, is diversification. Don't put all your eggs in one basket.
Makes sense. Spread the risk.
Exactly. And in private credit, there are a few ways to do that.
Like what?
Well, first, you can diversify across different types of loans. You've got senior secured loans. Those are the least risky because they're backed by things like real estate or equipment. Then there's subordinated debt, riskier because it's lower down the ladder when it comes to getting paid back.
Okay, so it's like levels of risk.
Yeah. And then you've got mezzanine financing. It's kind of a mix of debt and equity, offers higher potential returns, but also more risk.
So it's like a spectrum with senior loans on the safe end and mezzanine financing at the riskier end. And by combining those, you can adjust your portfolio to your own risk tolerance.
That's the idea. But diversification isn't just about the types of loans. You also want to spread your investments across different industries, different regions, and even vintage years.
Vintage years, like wine.
It's a good analogy. In private credit, vintage year refers to the year a fund was started. By investing in funds from different years, you're basically diversifying across economic cycles. So if one particular vintage year doesn't do well because of, the economy, your whole portfolio isn't sunk.
Ah, smart move. So diversification is all about not putting all your money in one place, spreading the risk, maximizing your chances.
Exactly. It's not just about avoiding losses. It's also about making sure you're in the right place to capture those gains.
This has been eye-opening. We've learned about the different flavors of private credit, from the more conservative to the more adventurous. We've even got some strategies for building a portfolio. But as we wrap up this deep dive, it's important to remember that private credit, it's not a magic bullet.
It's not a shortcut to riches.
Right, and it's not for everyone. Before jumping in, do your homework, know the risks, make sure it fits your goals, and how much risk you're comfortable with.
And if you're not sure where to start, or if it's all feeling a bit overwhelming, talk to a financial advisor. They can help you navigate this complex world and make smart choices.
So, as you consider the world of private credit, remember, knowledge is power. Stay informed, stay alert, and always approach this market carefully and thoughtfully.
Private credit can be a great tool, but it's not something to rush into blindly.
We hope this deep dive has given you the insights and the knowledge you need to navigate the exciting but sometimes unpredictable world of private credit. And remember, finance is always changing. So keep learning, keep asking questions.
Thanks for joining us. We'll see you on our next deep dive.